Hello guys. Welcome back to my YouTube channel. In this video, I am going to discuss about 3 stocks from different sectors which are fundamentally strong and have huge growth potential and currently trading at under rupees 100. Please don't skip the video and watch this video until the end, as there will be a lot of power-packed learnings one should know being an investor. First stock is Easy Trip Planners Limited, or popularly known as easemytrip.com. easemytrip is an Indian online travel company founded in 2008 by Nishant Pitti, Rikant Pitti, and Prashant Pitti, headquartered in New Delhi. The company provides hotel bookings, air tickets, holiday packages, bus bookings, and white label services. easemytrip has overseas offices in Singapore, UAE, Maldives, and Thailand, with country-specific websites for UAE, UK, and Thailand. Now let's analyze the fundamentals of easemytrip. easemytrip has market cap of rupees 7,014 crore. Price to earnings ratio is 47.8, which is bit on the higher side against the industry pay ratio of 37. But stock has corrected from its 52-week high of rupees 73.5 and currently trading at a discounted price of rupees 40.4. Let us understand the pros of this company. The company is expected to give good quarter. Company has delivered good profit growth of 103% CAGR over last 5 years. Company has a good return on equity track record of past 3 years, that is 48.7%. These two last points, I feel that they are very important for a share to become a multibagger share. Let's understand the red flags as well. Stock is trading at 18.1 times of its book value. Promoter holding has decreased over last quarter by 3.60%. Debtor days have increased from 98.5 to 138 days. Working capital days have increased from 43.6 days to 316 days. Now let's go to the financials of easemytrip. As you can see in the screen, the sales are increasing at good pace during quarter-on-quarter and year-on-year basis. Also, the operating margins are improving. Net profit is increasing steadily over the years. If you observe here, for the March 2021 year ended, there was dip in the revenue and margins due to the restrictions on the domestic and international travel. Now let's go to the shareholding pattern. Promoter holds stake of around 71.30% in easemytrip, which makes this share attractive, and even you can see there is a stake of 5% from foreign institutional investors and domestic institutional investors. Besides, this company has a good track record of paying dividends and also bonus issues since it made its IPO and listed on 19th March 2021, which is a great sign. Second stock is from banking sector, that is IDFC First Bank Limited. IDFC First Bank is an Indian private sector bank formed by the merger of the banking arm of Infrastructure Development Finance Company and Capital First, an Indian non-bank financial institution. It is the first universal bank to offer monthly interest credit on savings bank accounts, lifetime free credit cards with dynamic and low annual percentage rates. The bank provides products and services related to retail banking, wholesale banking, and investment banking. But, among other products, home loans continue to be the biggest growth drivers for the IDFC First Bank. The bank also offers one of the highest interest rates for saving accounts in the country, with an interest rate of 7%. Vaidyanathan V, who is the current Managing Director and CEO of IDFC First Bank Limited, he has immense experience and who had also previously worked for Executive Director of Retail Banking within ICICI Bank to build their business. IDFC First Bank has market cap of rupees 58,468 crore. Price to earnings ratio is 21.4, which is in par with industry price to earnings ratio. Considering IDFC First is a bank, price to book value or PB ratio is a good parameter to analyze for better indicator of efficiency of fund utilization and for turnaround prospects. For IDFC First Bank, PB ratio is around 2.27, which is bit on higher side. But considering the high growth potential within IDFC First Bank, I personally feel that is still fine. The stock is currently trading at a price of rupees 88.2, which is almost closer to its all-time highs of rupees 89.5. I would say it's better to wait for a good dip in this stock, or one can buy in dips rather than jumping to invest entire amount of investment, since most of the banking stocks are trading at their all-time highs including IDFC First Bank. Let us understand the pros of this company. Company is expected to give good quarter. Company has delivered good profit growth of 23.0% CAGR over last 5 years. The major red flags are: though the company is reporting repeated profits, it is not paying out dividend. In terms of dividend, I would say there is no necessity that company should always pay dividends to its shareholders. Alternatively, company can use that amount of cash for its growth and expansion, so that it can give better returns to its shareholders in future. Next red flag is that company has low interest coverage ratio. Also, company has a low return on equity of 5.18% over last 3 years. It has contingent liabilities of 3,63,404 crore rupees. Earnings include other income of 4,975 crore rupees. Now let's analyze the financials of IDFC First Bank. As you can see in the screen, the sales are increasing steadily during quarter-on-quarter and year-on-year basis. Also, the operating margins are improving. Profit before tax is increasing steadily over the years. The major reason behind this growth is that the bank transformed from infrastructure to retail banking in 4 years since the merger, increasing the current account savings accounts ratio from 8.6% to 49.77% at 31st March 2023, and increased retail deposits from 27% to 76% of total deposits. Now let's go to the shareholding pattern. Promoter holds stake of around 39.93%, and you can see even foreign institutional investors and domestic institutional investors are increasing their stake in this share. Third stock is Trident. Trident India Limited is an Indian textile and apparel company established in 1990. The company headquarters is in Ludhiana in Punjab. It is a leading diversified group of businesses and is the flagship company of Trident Group. The company is the largest terry towel and wheat straw-based paper manufacturer in the world. It operates into major business segments, textiles and paper, with its manufacturing facilities in Punjab. The company spans over more than 75 countries across 6 continents and comprises of global retail brands like Ralph Lauren, Calvin Klein, JCPenney, IKEA, Target, Walmart, Macy's, Kohl's, Sears, Sam's Club, Burlington, etc. Trident has market cap of rupees 16,766 crore and price to earnings ratio of 41.5, which is in line with the industry. Currently it's trading at a price of rupees 32.9. The stock has corrected almost around 50% from its all-time highs of rupees 64.80 in January 2022. Since then it has been in downtrend, mainly because of the following reasons, which I will explain as we analyze the financial statements of Trident. If you see the revenue in 2020 and 2021, pandemic and lockdowns hurt Trident's business. But what followed was a sharp recovery as positive developments rolled in for Indian textile industry. especially for the exporters to the US market. However, the company has fell short of expectations and hasn't lived up to the hype which you can see in Trident's share price. But later, in FY 2020 the production of bed linen, yarn, chemicals, and paper saw a sequential decline. To worsen it for Trident, the whole textile industry was in pressure due to the demand pressure in the export markets and higher raw material prices due to high inflation. If you see during last 1.5 years, India's textile domestic production is low and even exports have decreased. These exports are decreased due to the strong competition from China and Bangladesh. Moreover, Indian government has allowed duty-free import from Bangladesh. Bangladesh is getting textile raw materials at cheaper price from China and then it is manufacturing the garments and exporting the same to India, which is very badly hitting the business of Indian textile companies like Trident. Now the next question is whether Trident come out of this problem? Yes, of course. First, I see this issue purely as a macroeconomic factor, which is general in case of any business, and there is nothing wrong with the fundamentals of this company. And we all know stock market will move based on cycle, and each sector would have its own golden time. Trident share can recover soon once there is growth in the textile production. Also, Indian government should come up with some policies within textile sector to boost domestic textile industries. Additionally, Trident has already planned a capacity expansion plan worth 21.16 billion rupees to be executed over 2020 to 2025, which can increase the capacity segment of yarn segment by 48%, sheeting segment by 59%, towel segment by 6%, and chemical and power segment by 118% and power by 28%. So, I would say management has been taking all measures for capacity expansion and for the growth of the company. Now let's go to the shareholding pattern. Promoter holds stake of around 73.19%, and interestingly, if you see, the promoter has increased his share in the company for the March 2023 quarter, wherein it shows that promoter has trust on his company and believes that his company can do well in the future. Besides this, the company has been consistently providing dividends to its shareholders and also provide discount to his shareholders on its products. These are the three stocks which have huge growth potential and could give good returns in long term. Personally, I would say if you are a long-term investor on any particular share and would like to own it for next 10 to 15 years, and for example if you are investing a sum of rupees 10,000, then please don't invest the entire money at once. Divide these rupees 10,000 into 5 or more parts, say invest rupees 2,000 at one interval and invest other 4 parts of rupees 2,000 in different intervals. Suppose, if you invest rupees 10,000 at once and the stock price comes down suddenly, then you will be in more loss. Instead, add more quantities when a stock corrects so that you can get that stock at better average price. If you found this video useful, then please like, share and subscribe to my YouTube channel for more such contents regularly. Thank you for watching. Please note that this video is for educational purpose only and not a buy or sell recommendation. Also, please note that these three stocks are from mid-cap and small-cap sectors, which are highly riskier, so please invest wisely while doing your investments. Please consult with your financial advisor before taking any investment or financial decisions.